Hello, everyone. Today, we will take a closer look at Microsoft, one of the world's leading technology companies behind well-known products such as Microsoft 365, Windows, Azure, LinkedIn, and Xbox, along with a rapidly growing AI ecosystem centered around Copilot. In the first quarter of fiscal year 2026, Microsoft reported revenue of $77.7 billion, representing 18% year-over-year growth. Net income reached $27.7 billion, up 12.5% year-over-year, with a net margin of 36%, highlighting the company's strong profitability at scale. Earnings per share, EPS, came in at $3.72, exceeding expectations by 1.4%. Growth was primarily driven by the Intelligent Cloud segment, which generated $30.9 billion in revenue, up 28% year-over-year, supported by strong demand for Azure and AI-related services. Meanwhile, the Productivity and Business Processes segment continued to deliver steady performance, with $33.0 billion in revenue, growing 17% year-over-year. Now let's take a closer look at Microsoft's revenue breakdown in the first quarter of fiscal year 2026. In the Productivity and Business Processes segment, Microsoft 365 Commercial was the largest contributor with $24.0 billion in revenue, growing 17% year-over-year and accounting for 30.9%. Microsoft 365 Consumer generated $2.2 billion, up 28% YOY, representing 2.8%. LinkedIn delivered $4.7 billion, growing 10% YOY, or 6.1%. While Dynamics 365 reached $2.1 billion, up 16% YOY, accounting for 2.8%. In the Intelligent Cloud segment, Azure and Server recorded $28.9 billion in revenue, growing at approximately 30% YOY and representing 37.2%, continuing to be the company's primary growth driver. Partner and Enterprise Services contributed $2.0 billion, up 5% YOY, or 2.6%. Within More Personal Computing, Windows and devices generated $5.5 billion, up 5% YOY, accounting for 5.9%. Gaming delivered $3.7 billion, down 2% YOY, with a 7.1% share. Search and Bing ads also reached $3.7 billion, growing 15% YOY, representing 4.8%. Next, we can see Microsoft's revenue trend over time. Total revenue increased steadily from $50.1 billion in Q1 FY23 to $77.7 billion in Q1 FY26, driven primarily by Intelligent Cloud and Productivity and Business Processes, while More Personal Computing grew more slowly and showed greater volatility. On a year-over-year basis, Intelligent Cloud maintained strong growth and accelerated to 28% in Q1 FY26. Productivity and Business Processes delivered stable growth, reaching 17% YOY, whereas More Personal Computing slowed to just 4% YOY. It is also important to note that starting in Q1 FY25, Office was renamed and expanded into Microsoft 365, and Microsoft reclassified certain revenue streams, including EMS, Power BI per user, and Windows Commercial Cloud, into Microsoft 365. This change affected period-to-period comparisons, but did not impact total revenue. Microsoft 365 continues to expand its user base, with commercial seats increasing from 311 million in Q1 FY22 to 446 million in Q1 FY26, while year-over-year growth has slowed from around 17% to 6% due to high penetration in the enterprise segment. Despite this, Microsoft 365 Commercial Cloud revenue still grew 17% in Q1 FY26, driven by upgrades to the E5 plan and increasing adoption of Copilot, particularly among small and medium-sized businesses and frontline workers. In the Microsoft 365 Consumer segment, subscriptions rose from 54 million to 90 million, alongside 28% revenue growth in Q1 FY26. even as subscription growth moderated to around 7% YoY. This indicates that Microsoft 365's growth focus is shifting from expanding the user base to increasing value per user, supported by premium offerings and AI capabilities such as Copilot, with usage growing at approximately 50% per quarter, according to CEO Satya Nadella. LinkedIn's user base continues to expand steadily, reaching approximately 1.3 billion users, reinforcing its position as the world's largest professional networking platform, with a CAGR of 11.2%. At the same time, revenue has grown faster than the user base, with a CAGR of 16.2%, highlighting improving monetization over time. This trend continued in Q1 FY26, as LinkedIn's revenue increased 10% year-over-year. Growth was primarily driven by marketing solutions, supported by higher advertising spend due to improved targeting efficiency and conversion rates. Meanwhile, talent solutions declined slightly amid a still weak global hiring market, although user engagement and advertising effectiveness improved compared to the prior quarter. Next, we turn to Dynamics 365, a suite of AI-enabled ERP and CRM solutions that helps enterprises manage sales, services, finance, and supply chains more effectively. In the CRM market, Salesforce leads with 21% market share, followed by Microsoft Dynamics 365 at approximately 5.2%, alongside major competitors such as Oracle and Adobe. In ERP, SAP holds the top position with 16.4% market share, while Microsoft accounts for around 6.6%, competing with Oracle and Workday. In terms of market size, the global CRM market is projected to grow from $45 billion in 2020 to $158 billion by 2030, representing a 13.38% CAGR, while the ERP market is expected to expand from $46 billion to $123 billion over the same period, with growth concentrated in North America, Europe, and Asia-Pacific. Although Dynamics 365 does not yet hold a large market share, it is well-positioned for significant growth, supported by expanding market opportunities and deep integration within the Microsoft 365, Azure, and Copilot ecosystem. Next, we turn to Intelligent Cloud in Q1 FY26, which remains Microsoft's primary growth engine. During the quarter, Intelligent Cloud revenue increased 28% to $30.9 billion, with Azure and other cloud services growing approximately 40%, driven by strong AI demand and large-scale enterprise contracts. This momentum is clearly reflected in the global cloud infrastructure market, which reached approximately $107 billion in Q1 FY26. Within this expanding market, Azure continued to gain share, surpassing 20%, further solidifying its position as the world's second-largest cloud infrastructure provider and a key beneficiary of the AI wave. Looking across Microsoft's entire cloud portfolio, Microsoft Cloud generated $49.1 billion in revenue, up 26%, with a gross margin of 68%. While margins declined slightly year-over-year due to increased AI investment, operational efficiency improvements allowed results to exceed expectations. Enterprise demand remains exceptionally strong, as reflected in robust RPO growth, particularly from Fortune 500 renewals. To meet this demand, Microsoft plans to increase AI capacity by more than 80% this year and significantly expand its data center footprint. Management noted that Azure demand continues to exceed available capacity, underscoring substantial growth runway ahead. The global operating system market shows that Windows maintains approximately 31.1% market share, ranking second worldwide and continuing to serve as the core operating system for PCs and enterprise environments. After a period of weakness, Windows has shown signs of recovery in FY26, reflecting enterprise device refresh cycles, system upgrade demand, and the deeper integration of AI and Copilot into Windows. Despite slow but stable growth in the overall OS market, Windows remains a strategic platform for connecting users to Microsoft software and cloud services. This trend is clearly reflected in Q1 FY26, as Windows OEM and devices revenue increased 5%, with Windows OEM growing strongly by 18%, driven by PC upgrade demand ahead of Windows 10 end of support. While the device market continues to face inventory pressure, the strength in Windows OEM highlights Windows' central role in the PC recovery cycle and its continued importance as an anchor for expanding Microsoft 365, cloud, and AI services across Microsoft's ecosystem. Turning to Microsoft's gaming business, the chart highlights a high, with performance heavily skewed toward the year-end holiday season, when console sales, promotions, and consumer spending peak. Following the launch of Xbox Series X/S in late 2020, hardware revenue surged briefly, before cooling rapidly as the console cycle matured, underscoring the structural volatility and limited long-term growth profile of hardware. Against this backdrop, Microsoft has increasingly shifted its gaming. The ZeniMax Media acquisition in 2021, $7.5 billion, expanded Microsoft's first-party IP portfolio, while more than 3 years later, the Activision Blizzard acquisition, $75.4 billion, nearly 10 times larger, marked a step change in scale. As a result, content and AMP services revenue moved to a structurally higher and more stable level, clearly visible in the chart. Q1 FY26 results reflect this strategic transition. While total gaming revenue declined 2%, pressured by weaker hardware, Xbox content and services revenue still grew 1%, confirming the shift away from console-driven cycles. New releases such as Keeper, Ninja Gaiden 4, and Outer Worlds 2 supported engagement, and Minecraft reached a record 155 million monthly active users, reinforcing Microsoft's content-led, ecosystem-driven gaming model. Now, let's look at the global digital advertising market. The market is estimated to reach around $650 billion in 2025 and is projected to grow to over $1.04 trillion by 2030, representing a CAGR of approximately 9.9%. In terms of market structure, search accounts for 38% of total ad spend, where Google maintains a dominant position, while Microsoft Bing holds roughly 4% of global market share, with a stronger presence in key markets such as the US, 9.6%, and China, 15 to 16%, second only to Baidu. Social networks represent 31%, led by platforms such as Facebook and Instagram, while streaming video accounts for 22%, dominated by YouTube and TikTok. The remaining share belongs to retail media, primarily driven by Amazon, TikTok Shop, and Alibaba. Against this backdrop, Q1 FY26 shows Microsoft capitalizing on its position in search, with search and news advertising revenue growing 16% year-over-year, supported by higher query volumes and new distribution partnerships. At the same time, Microsoft Edge continued to gain share for the 18th consecutive quarter, aided by the integration of AI-powered workflow automation features, which enhanced user engagement and advertising effectiveness. Next, we look at the adoption and market positioning of ChatGPT and Copilot. The chart shows that ChatGPT's monthly traffic has surged from approximately 1.6 billion to nearly 6 billion visits, highlighting the rapid mainstream adoption of generative AI chatbots across both consumer and workplace use cases. As of November 2025, the ChatGPT ecosystem, OpenAI-powered, account for 73.9% of the generative AI chatbot market, with ChatGPT, excluding Copilot, holding 61.3% and Microsoft Copilot representing 12.6%. In parallel, AI engagement has reached roughly 900 million users, including about 810 million users on OpenAI platforms and 150 million monthly active users across Microsoft's first-party Copilot products. Notably, Microsoft 365 Copilot has grown 50% quarter-over-quarter, is now deployed by more than 90% of the Fortune 500, and agent usage has doubled quarter-over-quarter, signaling deeper AI integration into enterprise workflows. At the infrastructure layer, the renewed OpenAI partnership allows Azure to remain the exclusive platform through 2030, with OpenAI committing an additional $250 billion in Azure services, reinforcing Azure's position as a strategic, planet-scale AI infrastructure. Within the developer ecosystem, GitHub has reached 180 million developers, with GitHub Copilot used by 26 million developers. The launch of Agent HQ positions GitHub as the orchestration layer for multimodal AI coding agents, strengthening integration across AI models and solidifying Microsoft's long-term advantage in AI-driven software development. Next, the income and expense chart illustrates Microsoft's ability to convert revenue into profit. From $77.7 billion in revenue, the company incurred $24.0 billion in cost of revenue, generating $53.6 billion in gross profit with a 69% gross margin, which declined slightly due to a higher mix of AI-related products. After $15.7 billion in operating expenses, led primarily by our and AMP winking and laughing, operating income reached $38.0 billion, representing a 49% operating margin, up 24% year-over-year. After taxes and other items, net income totaled $27.7 billion, corresponding to a 36% net margin, while EPS reached $4.13, up 23% year-over-year. Cash generation remained strong, with cash flow from operations increasing 32% to $45.1 billion and free cash flow rising 33% to $25.7 billion. Capital expenditures totaled $34.9 billion, with approximately half allocated to short-lived GPU and CPU assets and a remainder invested in long-lived infrastructure, including $11.1 billion in finance leases for large-scale data centers. Cash paid for PP and AMP. It was $19.4 billion, reflecting timing differences. On the commercial side, commercial bookings increased 112%, while commercial RPO grew 51% to $392 billion, with an average contract duration of approximately 2 years, indicating strong near-term demand. Next is the operating income by segment for Microsoft. Total operating income increased from $21.5 billion in Q1 FY23 to $38.0 billion in Q1 FY26. Productivity and AMP. Business processes was the largest contributor, with operating margin expanding from approximately 50% to 61.8%, supported by a software and subscription-based model with low marginal costs, driving segment operating income to $20.4 billion. Intelligent Cloud continued to grow operating income to $13.4 billion, although margin remained lower at 43.3%, reflecting the capital-intensive nature of cloud infrastructure and higher operating costs. Meanwhile, more personal computing contributed the smallest share of operating income at approximately $4.2 billion, with a 30.3% margin, consistent with the structurally lower margins of hardware and consumer-oriented businesses. Looking at Microsoft's operating expenses from Q1 FY22 to Q1 FY26, research and development, R&D, AMP winking and laughing, has been the fastest-growing cost category, with a CAGR of approximately 9.8%, outpacing both general and administrative expenses, G and AMP, A, 8.8%, and sales and marketing expenses, S and AMP, M, 5.9%. This differential growth has resulted in R and AMP winking and laughing accounting for an increasing share of total operating expenses, signaling a sustained shift in cost structure toward technical and product development. This pattern is reflected in Q1 FY26, when our and AMP winking and laughing spending reached approximately $8.1 billion, up about 8% year-over-year, and serve as the primary driver of the 5% increase in total operating expenses. The expansion in our and AMP winking and laughing spending is structurally supported by Microsoft's workforce composition, with approximately 80,000 employees dedicated to our and AMP winking and laughing, compared with 44,000 in sales and marketing and 15,000 in G and AMP. A. This headcount distribution underscores a deliberate allocation of resources toward engineering and product capability rather than go-to-market expansion or administrative scale. Importantly, despite this sustained increase in our AMP winking and laughing investment, operating margin expanded to 49% in Q1 FY26, indicating that higher technical spending has been absorbed through revenue growth and operating scale rather than diluting profitability. Revenue increased from $46.2 billion in Q1 FY22 to $77.7 billion in Q1 FY26, with sustained double-digit year-over-year growth over multiple years. Net income rose from $20.5 billion to $27.7 billion, though growth was more volatile, peaking at 47.6% YOY in Q1 FY22, weakening during FY23, including periods of negative growth, and then recovering from FY24 with several quarters delivering high teens to low 30s YOY growth. In Q1 FY26, net income reached $27.7 billion, up 12.5% YOY, reflecting growth on a high comparison base. Net margin, meanwhile, declined from 44 to 41% in FY22 to approximately 31 to 35% in FY23, alongside weaker and more volatile net income growth. From FY24 onward, net margin stabilized in the 34 to 37% range, reaching 35.7% in Q1 FY26, while net income continued to grow in absolute terms. This reflects a shift to a lower but more stable profitability baseline as revenue scale expanded. Microsoft's reported revenue from FY22 through Q1 FY26 has closely tracked market estimates, with most quarters coming in line or slightly ahead of expectations. This reflects the high stability and visibility of the revenue base, supported by enterprise software and cloud services. In recent quarters, revenue continued to expand, reaching $77.7 billion in Q1 FY26, reinforcing expectations for continued growth. By contrast, EPS has delivered more consistent upside versus estimates. Reported EPS has frequently exceeded consensus, indicating earnings growth outpacing revenue growth. EPS increased from $2 in FY22 to $4.13 in Q1 FY26, driven by operating leverage, margin improvement, and cost discipline. Looking ahead, EPS growth is expected to moderate as investment and infrastructure spending remains elevated. Investor sentiment toward Microsoft stock remains strongly positive. Based on consensus from approximately 52 analysts, the average 12-month price target is around $629, implying roughly 32% upside from current levels. The bull case reaches as high as $730 plus 53%, while the bear case is near $500 plus 5%, reflecting a broadly constructive outlook despite a wide range of estimates. In terms of ratings, the majority of analysts maintain a strong buy recommendation, with 53 strong buy ratings, alongside a smaller number of buy and hold ratings and virtually no sell recommendations. This indicates broad institutional support and confidence in Microsoft's long-term earnings trajectory and strategic execution across its core businesses. Thank you for watching. The information presented is based on sources believed to be reliable and is provided for informational purposes only. It does not constitute investment advice or a recommendation.